Hello, everyone. Welcome back to the channel. Matt with Green Bar Trading. Another weekly watch list video for you guys. We're going to break down everything we need to know for the week ahead. Before I get started, hit that thumbs up for the video. I do appreciate it. And thank you so much for watching. Let's jump right into it. Because last week was a wild week. And this week is shaping up to possibly be the same. What I'm interested in this week is one thing and one thing only. That is 2 o'clock on Wednesday. The FOMC will release their rate decision. So what the consensus is right now is for a 75 basis point move, which would bring us from 2.25 to around the 3% area. And then at 2:30, very important, that's when Powell will speak. A lot of times, this type of day can be very volatile to trade. You might see a move one way, and then when Powell speaks, you see a move a different way. This happens often. Doesn't mean it is going to happen or has to happen, but this is just one of those huge days. I already know most market participants are waiting for that. So you're going to see most likely Monday and Tuesday of being sort of lower on the volume or repositioning portfolios ahead of this. So just be aware. Wednesday is really important. And this brings me to my point of this video. Last week, the CPI report changed the market. It came in with hotter numbers than expected, while the market was pricing in, and they thought that the CPI, and not just, just regular traders, but the big Credit Suisse coming out and saying that they saw CPI was going to fall off a cliff. And it didn't happen. They were totally wrong. So many people were wrong. And we saw inflation actually come up, especially the core CPI, which is what the Fed looks at. So anyway, inflation peaking is kind of a lost narrative now with those numbers, because you would have to continue to see month over month those numbers to go down, not up. So anyway, being aware of when these economic events, like I'm showing you guys, I show you every weekly watch list video, you have to know either the day before, what you're doing, what you're swing trading, know this and know that these things can really move markets. And it's almost like trading around earnings. If you take a gamble on a stock before their earnings report comes out, well, that's a gamble, just like trading before a CPI in this type of market or an FOMC rate decision in this type of market of a high VIX, where the moves on a daily basis are going to be really, really strong. So just keep that in mind. That's the economic calendar. The earnings for the week, we saw FedEx already pre-announce their earnings because they were so bad. So what FedEx did on Friday was they pre-announced their earnings, they took away guidance, and spoke of a global recession coming that they're seeing. And a lot of people look at these transports and these big companies like FedEx because they see a global demand. They see the shipping all over the world. Not good. That really rattled markets at the end of the week. And when something like that happens, if we continue to see more companies do that, we could really, really go lower in the market. That's not what I'm calling right now, but you have to be aware of and get ahead of those possible things if they start to lower expectations and the earnings. So that's what FedEx did there. going over to just the other economic calendar. This is just US. Like I said, Wednesday, that's all we care about. And then last week's relative performance. I always like to look at the sectors, and the sectors that are outperforming, like they have all year long. Energy, healthcare, utilities. These types of things are outperforming the overall market. They're still in the red for the month, for the week, for Friday. But the ones that are outperforming are all defensive in nature, which means a possible recession. These are the things that people, and high inflation, these are the things that investors put the money from their portfolios into. They're not really, diving into technology, which is down over 14% on the month. Really, really not good for tech, especially if we see rates that last longer and they go higher. And that brings me to my next point. The Fed's terminal rate, all right? This is really important because after the CPI report came out on Tuesday, after that came out, I believe it was Tuesday, the market implied, so this is where investors forecast how high the Fed will raise their terminal rate. And you can see here, this is October, and then January of 2023, and then April. They have it peaking now in April up to 4.45% for the interest rate. With our new raise of the interest rate, will only be at 3% if they do the 75, which means a lot more rates to go up. And just last week before the CPI, investors had it down at 3.94. So the market had priced in, maybe 2 more rate hikes, maybe 3 more rate hikes, depending on if they do 25 basis points. So that drastically jumped up. When that happens, after CPI being hot and not showing that inflation rolling over, what ends up happening are the 2-year bond. So the 2-year Treasury bond, this is what follows that terminal rate and where they see the Fed eventually going to. So that's the 2-year. The 2-year will really follow that. And that's why we saw just in the last week, it went from 3.56, 30 basis points higher. 30. A huge move. It's been a huge move. As inflation numbers get higher and hotter, the 2-year has to catch up to where it thinks the Fed funds rate will end up. So that's why you see this now at 3.87, which is extremely high, the highest we've seen since 2007. So that's what ends up happening there on the 2-year. Now, if you compare this to the NASDAQ, you have a total different correlation here. So what the 2-year going up, you have the NASDAQ going down. So inflation, a tighter Fed, higher rates higher for now possibly longer. That's what the market is starting to price in. And you can look at that with the 2-year, all right? So really important that you guys understand the relationships between the bonds, the yields, the Fed with their rates, and inflation. Now, the 10-year, if we look at that, I'm going to show you guys the 10-year. What the 10-year a lot of times will do, and you can see this is an inverted curve with the 2-year. Anytime a 2-year is yielding more than a 10-year, it almost always predicts a recession is coming. So right here, you can see we're peaking at those June lows, right? That's when the 10-year hit its highest mark. And now we're coming back to that right here. So you can see August, September, it's just been rising the whole way. The only thing is the 10-year, if there is going to be a recession, the 10-year will actually continue to actually drop. So keep in mind, these things are all interrelated with the stock market. So there you go. So hopefully you learned something new. Now, getting into our compass, our SPY, all right? What are we looking at on this chart right here? Well, something I noticed is I have the 20 EMA on my chart. You guys know I have the 50 SMA and the 200 moving average. I find that these are very important indicators on the daily chart. I only use these on the daily. So looking at this, every time the 20 crosses over that 50, right? So you get a crossover here. You can see where the arrows are. We've seen the market tank. Crossover here, we saw the market tank before the 20, ever came back and crossed it over on the other side. Once the 20 crosses over the 50 going back up, we saw the market break out. And now what we're seeing, and I'm going to zoom in a little bit more on this, we're seeing that crossover again. So the 20 EMA is crossing over. We have a 50 moving average right here that we're now trading under, and the market pulled on back. How far we go down is anybody's guess. I'm not going to try to guess. I'm just going to show where the support has been. So we traded just about as low as this support that I have from the weekly, about 381.86. We hit and ended up closing up, which was nice. It was a nice bounce back. Not going to say that this is the start of another run up. The thing I will say is RSI is now getting a lot lower, but we are ahead of that big Fed meeting. So just looking at the charts here, before we, when we made our last weekly watch list video, we were at this trend line, just over the trend line. We were over the 50 moving average. The CPI number comes in and totally changes all that. Like I say all the time, those big economic events can destroy technicals. So you always have to be aware of that. So our trend line, our ascending trend line is broken. We're under the 50 again. We're under the 20. The 20 crosses over the 50 or under, whichever way you want to look at it. Right now it's bearish. We had a lot of volume on Friday because of quadruple witching. We've seen a lot of volume because of CPI. There's a lot of shaking out going on. What I would like to see, because I really do believe that there's enough companies out there that are very good deals. This is where I would be building a watch list if I was you guys, of stocks with PEs under 10, really solid companies where you're getting a good deal for the next 3 years, because eventually there is going to be a bottoming out. Will we retest the lows here? Who knows? But even if we do retest these lows, that's not that far away. And I'm going to if you take out these 2 days here, that's 370. We were just trading at 382 at the lows here. That's really like 1 or 2 bad days. It could even just be one really bad day where all of a sudden you have an opportunity there, where we retest these lows. Maybe we don't go all the way down. Maybe we do go all the way down. But either way, there'll be stocks where you're going to see some really good deals. Now, the only issue is I don't know at this point how much the stock market is pricing in a recession for possibly 2023 and 2024. That's the issue that we're seeing right now. And that's why you see a lot of these really bad days in the stock market, where you see these bear market bounces and then just a continued sell-off. We're still in a downtrend for the year. All right. Most of the times, if you're making lower highs, you tend to make lower lows as well. So as far as technical analysis goes, you would almost seem to think that those lows eventually, I don't know when it would happen, would have to at least be tested at some point. Just based on this chart, based on the lower highs that we're seeing. If you start to put in those lower lows, that's a good sign too. But that chance kind of broke here. We're still at support, so we'll see what happens. We're still, over 380, but Wednesday's a big day. So let's see what ends up happening with that. That's the SPY. So let's go to the Qs. Same thing. We have the 20, the 20, and the 20. And now we're coming down. So we traded as low as 285, really not that far away from retesting the lows for the Qs. At this point, we were about 28% off of the highs for the year. That's a really bad year, okay? I think pretty sure this, let's just go back and look and see what the S&P 500 is at this point where we closed to the high of the year, just about 20%. We just bounced around that 20% area. So it's still trying to stay over that. It's just about at that 20%, which is really a lot. That's a lot for a market to be down in a year. I don't think we're going to finish the year down 20%. Even if we finish the year down 10% or down 12% or 14%, at some point, there's going to be a rally, maybe into the end of the year. Midterms tend to do that. So just keep that in mind. This is just what I see on the Qs, like I showed you guys. We have the 200 moving average on the weekly chart, which is right here at the June lows. Let's see what happens. I mean, we broke support. Once we break support, it's a lot harder to come back. But then again, we have FOMC coming up. How long will they keep rates higher for longer? That's really what everybody's going to be looking at. Because how this is not going to end in recession is going to be really difficult. You have the Dow Jones, which is the DIA, also just about retesting. So it retested to 305. We saw a lot of buying in this area and had a nice bounce back on Friday. So we'll see where that one goes. But, under all the major moving averages, it's still very bearish, obviously, but the RSI is getting down there. IWM, we gapped down and broke this ascending trend line, but had a nice bounce back up. So anyway, this is just breaking trend, and we'll see what happens. But that's a lot of volume on Friday with the quadruple witching. And now you're coming back up and retesting this trend line. We got to wait and see with the FOMC. As far as picks for the week, I'm not doing any of that this week because of one thing, that FOMC. I feel like it's gambling this week. Everything has broken down. If we look at Amazon, Microsoft broke this ascending trend line and literally bounced just about to the penny off its lows for the year. Disney broke down. Facebook broke down. XLE even broke its trend. Pfizer is the only one that's holding up. We've seen this happen before where it'll bounce down, break back up, come back down, and then hopefully we'll see where it goes. But if the market stays up, healthcare is not a bad place to be. Airbnb kind of has this cup now, but that's pretty big pullback from 129, just about 10 points down closed on Airbnb. So as of right now, seeing these major stocks, let's take a look at Google, but seeing these major stocks all breaking support, Google's another one. Everything broke support. You got to keep that in mind. When these big companies are breaking down, well, that's where our market is breaking support. So that's why I always like to look at our compass. If we're going to break support here, a lot of other stocks are also going to be breaking their support. So that's it, guys. Hope you enjoyed this. Maybe you learned something. If you did, like I said, please hit the thumbs up. Thank you so much for watching, and I'll see you on the next one. Take care, guys.